All right. Hello. Welcome, everybody in the Webosphere world. My name is Paul Adams. I'm president and CEO of Sound Financial Group. So welcome to our one of many educational and informative webinar series. This one's called After the Crash. What do you do? What comes next? Because we don't know what's going to happen in the market. But before we jump into our material today, let me spend just a couple minutes with you. If you're new to our firm or perhaps haven't been to one of our educational events, our goal is to make sure we're doing everything we can to help our clients design and build a good life. So we are doing and experimenting with new things like a live broadcasting webinar, as opposed to the old only screen share kind of webinars that are in the marketplace. Second, we just want the opportunity, if you've not yet had a chance to meet with one of our advisors, we'd like to give you a chance to do so. You're going to have a chance to do that later on. We're starting here at 12:15. We're going to be done by 12:45. Just a 30-minute financial bite for you and your family. But let's just talk a little bit about the ways that you could engage with us. Well, one, you could get my book, Sound Financial Advice. Coming up in February, you're going to be able to explore more about the knowledge our advisors work to teach our clients every day through the podcast series, Sound Financial Bites. Now, if that sounds like it's of interest to you, the Sound Financial Bites, and you're not getting our regular newsletter right now, just chat in the chat panel that you'd like to know when that gets released. Should happen here in February, but it's a great way for us to connect with people. We also have live events. So it's February 26th. We have an evening date night about money at the Kirkland Hotel here, or the Heathman Hotel here in Kirkland in the Seattle area. And we will be webcasting that for any of the people that are kind of outside the area, more than 20 miles away, so that they can still get that financial knowledge. And why do we do any of this? We do it because we know if we help you as a client become more knowledgeable about money, it becomes easier for your advisor to do the important work that they do for you and your family. And it makes you more autonomous. It gives you more freedom and gives you the opportunity, to better grow a better financial picture and to help you fundamentally do what we call designing and building a good life. And we just want to help you there. So today's subject on After the Crash. We've had so many things go on in the marketplace. We watched the market dip earlier this last year, about summertime. And now we've had this recent market slip. And the question becomes, what do we do? What do we do when the market does what it does? And I think history is a great example for us to look at. What do they say? I remember I had a history teacher that taught me those that don't learn history are doomed to repeat it. And I think more importantly, that those that don't learn about history of what's happened in the markets are doomed to make the mistakes their predecessors did. So I'm going to be kicking back and forth a little bit of this live stream that we're doing right now and going into a PowerPoint deck just so you can see some of the graphs. And I'm going to do everything I can to make this as engaging as possible. All the while, we're experimenting with this whole new platform of live streaming coupled with being able to share information. So we're hoping you like it. If anything worked or didn't work for you in this, please put in that chat panel, and we'd love to be in a conversation with you. Alex McKay from our advisor planning group that works in the back office is watching that chat panel. He'll be communicating with you and watching if there's anything we need to do differently. And we look forward to this being our maiden voyage together. So when we look at, the crash, whenever the crash is. Now, are we in the crash right now? I don't know. Is the market going to come right back after this recent pullback? We don't know. But what we do know for sure is what's happened in the past. Now, an incredibly famous investor by the name of Benjamin Graham said the following, is that investors who have either the enterprise or the money to invest now somewhere near the bottom are likely to prevail over those who wait for the bottom and miss it. Now, for all of us, let's think about that. Too often what happens is people sit back with their money. They don't invest because they don't know where the bottom is. Now, without pulling it up on screen and sharing it with you, let me share with you about an opportunity I had, a unique one. I incredibly enjoyed it. It was a chance to be at this beautiful home on Lake Union with about 20 financial professionals, most of whom managed enormous amounts of money. Either they owned large mutual funds or they were literally CFOs and portfolio managers for some of the wealthiest families here in the Seattle area, or hedge fund managers. And as everybody was sitting around talking, they were talking about, what do we do if the next big stock market calamity is coming? What if this is the Great Depression? Which, by the way, we're going to go all the way back to the Great Depression today in our 30 minutes. And one of the things that I just took in with knowledge that I talked to them about is I said, here's the thing everybody misses, is that when the market goes down like it went down back in 2008, which is the one they were all pointing to, and when it goes down like that, and you can take this, Google it, there's a little slider at the bottom you can move and you can see it for yourself, that literally, think about having $5 million. You would have had to have the fear that, oh my gosh, it's going to get bad, and you move all your money out of the market. And what you're going to see in our talk today is that even a well-diversified portfolio ramped up quite quickly. But just the S&P 500, you literally had to get out at just the beginning of the dip and then be all the way back in. And if you did that in less than 14 months, you may have had some profit. But if you waited 14 months, literally the market was almost back to where you would have exited, and therefore you would have had no gain from the prophetic view that the market was going to go down. And by the way, it's not just you. Nobody can do it. That literally there's a survivorship bias of all these hedge fund managers and all kinds of mutual fund managers that prognosticate, and the only ones left standing are the ones pointing and screaming that, hey, market's going to fall, and then the ones that get to spike the football when they're done. But much like everybody's looking at the receiver in the end zone and cheering them on because they're saying, hey, you scored a touchdown, there's so many people that never cross the line into the end zone and nobody's thinking about them. Everybody's just celebrating the touchdown. So literally the data we even get on a daily basis is skewed, not to mention how skewed it is to simply what the media brings to us, which I'll talk about more in a little bit. So here's market crashes from a historical perspective. So since 1928, there's been 87 drops of 10% or more. So let's hold on that for a moment. That's a lot of years, 1928 to today, and there's been 87 market drops of 10% or more. And there's only been 23 market drops of 20% or more, okay? Now, the market is volatile, okay? That is a truth. It's something that we can't get away from. But what we have to think about is, well, the market's volatile. Its volatility is what gives us rate of return. Let me explain. Lots of times people will say, I don't like volatility, but that's not true. People just don't like downside volatility. Everybody loves the upside volatility. That's why we're in it. So think about this. Since 1946, it's taken the market only 111 days to get back to its pre-crash levels. But the reason that we get the rates of returns we get from being in the stock market at all is because of the volatility. You see, if somehow someone somewhere could magically make all the volatility go away, or there were great companies that could perfectly be invested in that wiped out all volatility, then nobody would be willing to give us the rate of return that we get by tolerating the volatility and investing in equities. Simply put, as the volatility occurs, that's your correlative awareness to know that that's why the rate of returns are there. You see, otherwise we would have this very smooth line that goes up and to the right like a CD, right? That's what builds the wealth, is that we're willing to tolerate the volatility. So here's what we're going to do. For all of our analysis today, we're going to analyze the market falling apart, the market crashes historically with 15% in T-bills, 15% in 5-year government bonds, 10% US large cap, 10% US small cap, 11% micro cap US, 22% large cap value, 17% small cap value. So we have an incredibly diversified portfolio that we're going to watch in each of these market crashes and how it recovers. Now, this is key. You'll notice there's no international. We put international in all of our passive structured portfolios, although we don't have international data taking us back to 1926 and 1928. It's just not there. So we're analyzing this just with US markets to give everybody a sense of it. So let's look at this crash from November 2007 to February 2009. That's the one that's most recent and deep in people's minds. If you take it from the very high over the 16 months, the S&P 500 went down 50.95%. Now we talk about the media. Here's the kind of things that were in the media. This was on the cover of Time magazine, and they were saying, oh my gosh, the market's falling apart. It's never going back. And we're going to have soup lines like back in the Great Depression, which incidentally, you'll notice everybody talks about the Great Depression. It's where we're going to end today. But I think we need to be present to the fact that why do they always naysay and doom and gloom? Here's why. Here's why. I'm going to turn my camera back on for this. The reason they give you all the doom and gloom is it doesn't sell. If what happens is the market turns down, and the advice were, well, hold a academically allocated and globally diversified portfolio, rebalance and hold strategy. That's not going to sell magazines. But what's going to motivate people is fear and threat and concern. People don't keep their eyes glued to Bloomberg when they think it's all going to go well. They keep their eyes glued to Bloomberg or CNN because they think the world's falling apart. So what we have to do is use events like this one, these webinars, our podcasts, conversations, coaching conversations with your advisor to keep you on track and keep you from getting distracted by all of that. So what other quotes were going on back in 2008? Well, there were quotes like, mounting fears shake world markets, markets in disarray, new phase in finance is a crisis for investors. Well, what happened after the crash? March 2009 to December 2013, 1 year later, the market had climbed 57%. 1 year. 3 years later, it had gone up 22%. Like, we literally got a 22% annualized return after the market fell apart in the most recent downturn in the market that everybody seems to have in good memory. So let's go to the next one. Tech bubble, February 2001 to 2003, 22 months long, S&P total return down 36%. And it was looking beyond the bear. Now, again, Time magazine, look at the problems that are going to happen. Now, I don't know if you noticed, this is a really cool flip phone, right? We got the old StarTAC. But I love that this bear is comfortable and sensitive. He's got very comfortable shoes, and yet he's sensible because they're nice shoes. But looking beyond the bear, the quotes were, they've run out of options when it comes to the economy. The worst is over. Even if the worst is over, it's going to get worse. So let's look at what happened. Again, this is the growth of wealth, our simulated portfolio that's diversified alongside the S&P 500. And what happens? Well, the market rode, went through the next dip and then back up. So let's just look what happened over this 10-year period. Remember, everybody called this the lost decade? Not with a properly academically allocated and globally diversified portfolio. Because in 1 year, it was up 44%. In 3 years, 20% average per year. In 5 years, 12. And in 10 years, a 9.49% rate of return. The lost decade wasn't lost at all if you used a disciplined approach to investing. It was only a lost decade if what you had done is put yourself in a position where what you did is you didn't take appropriate action. You got out of the market, or you were undiversified. Let's do the next one. 87, September 87 to October 87. Now, believe it or not, this one was only 2 months long, but the S&P total return was 23.25%. It got crushed in an amazingly short period of time. It was the crash. The world is different. It's never going to be the same. Well, let's look at what was happening. George Soros, he said the crash of 87 bears an uncanny resemblance to the crash of 1929. Now, what was interesting is an administration official was quoted by the New York Times. What do you expect us to do? Announce the cabinet members will be buying IBM and General Motors tomorrow? Well, they didn't actually do that until many years later that the government bought General Motors. But That's like, there's nothing that has to happen. Lee Iacocca says the borrowing must stop. The market slide has shot us right in between the eyes and better wake us up. So what happened? Well, from 87 to today, you can see the graph by which someone's money would have grown in an academically allocated, globally diversified, passive structured portfolio. Now, what does that mean in actual returns for the investors? Well, 1 year later, it was up 19%. 3 years later, 6% annualized. 5 years later, 12% annualized. 10 years later, 14%. And 20 years later, it would have been about 12% per year in our hypothetical, fully indexed, no asset manager portfolio. Simply rebalanced every single year back to the original pie chart that you saw earlier. Gosh, it's not looking like these crashes did us all that bad. Perhaps they got worse. Let's do 73 to 74. 21 months long. Now we're talking 42% negative rate of return. I love this. Poor economy. It's got a big headache. Anything to get people to buy the magazines. I personally love how you can see the artwork change as we go back into the 70s. So now even nations are in danger of default. The slide is steep with no end in sight. Now, what is funny is you could have actually taken both of those quotes and superimposed them with dates from 2009, and they would totally match to what those same organizations, in this case Business Week, were saying. They just repeat the same stuff. No end in sight. This could happen forever. Because if it's going to happen forever, then we must tune into them for advice. So what happened? Well, there's our hypothetical portfolio and the S&P 500 again. And my goodness, since 1974, a dollar invested would have become like 20-some dollars. And as we move forward, we can see there was a 33% rate of return a year after. 3-year return was 26%. 5-year return 23%. 10-year 20.5%. And my goodness, a 20-year rate of return since the bottom of the crash in 74 would have been a 16.4% rate of return without an asset manager. Just an academically allocated portfolio. In this case, for our comparison, I've been talking about globally diversified because that's what we teach our clients to do. But even in this specific instance, it's just an academically allocated U.S. portfolio against other U.S. performers. And we're still at 16% per year. Okay, so 69 to 70, 7 months long, 19%. Now, it's an economy on the brink. Folks, it's a world of uncertainty. Americans are sick and tired of turmoil and distrust. They won't believe anything until there's a series of turnarounds. Well, let's talk about turnarounds. Well, it looks like our money would have done all right over this period of time. And on top of it, how would it have done 1 year later? 33%, 3 years, 8, 5 years, 7. It was a tough decade, but that decade finished at 12 from the bottom and 14% over a 20-year. And we've now traveled through several other recessions to arrive there. 1960s, going back further, 8 months back, 8 months long, S&P total negative return, 17.55. And there we have the bear killing the bull with ticker tape all around. There behind its gray stone walls and Corinthian columns, the New York Stock Exchange was shuttered through its worst week since 1950. In one hectic week, the paper value of these stocks was $30 billion, plunged $30 billion, which is more than the GNP Australia, Sweden, and Ireland. Nowadays, that's like a poorly structured road project cost us $30 billion. So what happened? My goodness, the free market worked. The market came back. And what happens is some of the greatest rates of return are happening after these crashes, after these troughs, because it creates the opportunity for returns to be generated for those people who not only continue to hold strategy, but continue to invest as a part of their regular strategy through the downturn. 23% the year after, 19%, 17%, 10-year, 11.87%, and the 20-year timeline, 12.61%. Okay, 46, 11 months, negative 20%. Now we're getting to where there aren't as much news media floating around out there, right? Stocks are beat down. Well, what happened? They had quotes like, a time when nearly everyone in this nation is feeling the pressure. It's far too late. It's far too late to fight against inflation. I don't know if you remember, like, inflation was out of control. So what happened to the market? Well, all we had to do is hold strategy. It's something many of you will hear from our advisors, is to hold strategy. 1 year, 14%, 3 year, 10, 5 year, 12.76, 10 year, 13.28, and 20 year, 12.4%. Right before I get to the big one, Alex, can you launch our offer to everybody? So what you're going to see show up on the side of your screen in just a moment is you're going to see an offer to be able to request a review of what you're doing. Like, we've all got whatever we're doing in our current finances. And one, if you're already a client, take some time with your advisor and start to understand how what the market's doing affects you, so that you can be, not only for yourself, have a good station and comfort, but it's going to make unbelievable difference for the people around you. It might be the reason why you want to make sure that you bring a friend to the date night at the Heathman Hotel, where we're going to talk about the illusions of investing. Or it may be the reason what you want to do is just introduce your advisor to one of those friends. But if you don't have a relationship with one of our advisors, then maybe what should happen is the risk tendencies in your portfolio and what it's costing you every year ought to get analyzed. And we do that inside of this platform called the Living Balance Sheet, that's going to actually give you the ability not only to see where your money is, but see how different parts of your money interact with one another, so we can help you optimize what you're doing to create at least the best possible outcomes that we can help you design to help you build a good life for the rest of your life. So I'm going to have Alex leave that up on the screen here for a little while. Right during, as we're finishing up the webinar today, you can click on that, put in your information. We will get that to your advisor, or if you don't have an advisor with us, we will get you connected with somebody. And we have no idea whether or not our process is right for you at this time, but we know if you spend 30 minutes in a phone call, we work with clients all over the country. It's normal for us. We do a great deal of work by web. 30 minutes in a phone call with one of our advisors is going to merit the time that you invest in it. So I want to welcome you to do that. So let's get to the big one. Here we are, 1929. This is bad. 34 months long. 83% downturn. Think about that. Just sit with that for a minute. Like, now, by the way, after every single stock market pullback and crash, people say it's never coming back. Now, I'll tell you right now, if it was ever going to never, ever come back, it would have been then. Negative 83% return in the S&P 500. That means if you had $100,000, it's now worth $15,000. Wall Street's routed. People are jumping out of buildings. It's the legend of 1929, just how horrible it was down on Wall Street. The quotes, country is not in good condition. Calvin Coolidge, stater of the obvious. Wall Street in panic as stocks crash. Yep. Wall Street lays an egg. And the wave after wave of selling again moved down prices. On the stock exchange today, billions and billions were clipped from values. So what happened? Well, this is over the next 20 years. So from the time of the beginning of the recovery, it's weird the stock market went up. History tells us that markets prevail, and we don't know when it's going to happen, right? Here's the thing we do know. The next 100% rate of return is going to be up with a well-diversified portfolio. It's going to be up. It's not going to be down, right? Like, think about this for a moment. That literally, if the market went down 100%, meaning thousands and thousands of companies became worth zero, we can refer to that generally as some kind of Armageddon. And nothing else will work in an environment where the free market is not driving the economy through equities. Simply put, Other things will be way more valuable than stocks, and you won't care where your money is at that point. If it gets to the point that we lose 100%. So we know the next 100% move is up, not down. For sure, the next 200% move is up, not down, but it's going to be over time. We don't know when it's going to happen. Nobody else can tell you when it's going to happen. And the prognosticators that try to tell you, you got to think about what it is that why are they prognosticating that? So 1 year, 226% positive rate of return. In 3 year is 41%. Now, here's the funny thing. I've never seen 41% look so small, but the graph scales against the 226%. But over a 20-year period after the Great Depression, it was up 17%. Let me tell a quick story. One of our advisors with the firm here, we've got some rough calculations. We don't have it all vetted out, but we'll just use this as a general example. His great-great-grandfather, he has some hand sketches. The next one of our webinars, I'm going to do my best to actually show it on screen. So he has these hand sketches of how he tracked his the market going up and down in the individual stocks that he owned. And we think that he had somewhere around $100,000 in the market back in 1929. But because of prevailing market conditions and an inability to hold strategy, which had to do with his own personal spending habits, etc., he had to liquidate those positions. So our rough calculation said that he should be worth somewhere between 50 and 70 million today. Had that great-grandfather been able to simply hold strategy in an academically allocated and consistently rebalanced portfolio. And right now, in the face of whatever's happening in the market or whoever wants us to sell or change our strategy, we get to be that opportunity of the person that held strategy over time so that our heirs get the opportunity to have the best outcomes. Our family, our spouses, and us in retirement get a chance to have these great outcomes. Because if what you did is you locked in your losses on December 8th, 2008 in the S&P 500 index, when US Treasuries were paying way less than 1%, how long would it take for you to rebound? Right? It's going to take a long time to make up those losses. About 2,400 years. Now, whether it's 2,400 years or 50 years, doesn't matter. It's that what we need to do is be able to stay in equities, because historically markets have always recovered over time. That exact market bottoms are impossible to predict by us, by you, or by anybody else in the marketplace. That market recoveries historically have been relatively fast. Like it's not like you get to wait around for 5 years and get back in. You could, in fact, you all have met somebody at a cocktail party who talked about getting out right before the tech market bubble or right before the stock market bubble. And what you should do if you want to just have fun with those people, say, let me ask, how long until you were fully back in? And what you're going to find is they didn't benefit from getting out at all, because they wait too long to get back in if the fear is what drove them out, because most of them are not doing it with strategy. The single largest historical recoveries followed the biggest crashes, and the highest historical returns generally follow a crash. So here's where we start, and I think an appropriate place to end. Investors have either the enterprise or the money to invest now somewhere near the bottom are likely to prevail over those who wait for the bottom and miss it. So here is my advice to you today. One, if you don't have a strategy that gives you a passive structured portfolio that you can be invested in today, if you do not have that, get it. You can do that with one of our advisors. If you are working with one of our advisors, have a conversation with them about whether or not you have a consistent investment strategy of money going in. Because if you have a consistent strategy of money going in, then it does two things. One, when the market's dropping, at least you're getting the chance to buy at those discounts. And the other things that's happening that nobody talks about. Let's go back to that portfolio at the beginning where it showed that what you could do is have, I think it was 30% in fixed income between short-term treasuries and 5-year bonds. If you're in that fixed income component, guess what? It's going to rebalance. Your money isn't going down when everything else is going down. And every year when the portfolio rebalances, you're getting the gains of the assets that did better during the downturn, buying those that didn't do as well. So we get the automatic chance to average down, even if, and I'm just scanning to pull up that slide, even if the market did not cooperate with you, you still get the chance to rebalance. And as you add money, you're getting the chance to rebalance every single time you add money. So what's the narrative? What's the like moral of the story today so that we can end on time? One, equities are volatile, and they are volatile, but what they do for you is they create the opportunity to produce return. That if we could negate all the return of the market, then no companies would be willing to pay us very much. They would pay us like CDs or government bonds. It'd be smooth and up and to the right. By being able to embrace that jagged component, it creates the opportunity to produce equity-like returns. Second, build a strategy, understand your strategy, then hold strategy. More damage has been done by people to their own financial affairs by breaking strategy than has ever been done by outside market forces. And lastly, and I can't say enough, make sure you have a coach. Make sure you have somebody working with you on your money consistently to help you make solid decisions that are based upon indisputable math and independent scholarship so that you know what you're doing, you know why you're doing it, and it'll help you and your family for generations to come. I'd encourage you to click on that tab that says request a review. I hope you've all enjoyed the webinar today. I hope you get a chance to invite other people with you. If you're in an office, don't hesitate to invite a few people in the office for our next one. We mean this to be consumed. We mean it to be shared because we want you to be able to design and build a good life. Watch for our podcast series. Get a chance to pick up my book if you haven't yet. And watch for 2016. We're going to have another book released by several of our advisors writing it together called Rewiring Prosperity. I hope you have a great day. And from Sound Financial Group, I wish you the best the rest of this week. Take care. Bye-bye.